All right. What's up, folks? Ladies and gentlemen, welcome to tonight's session, Trade or Fade. My name is Hamilton. We're going to start in about 30 seconds. See how many people want to show up. Tonight's session, we're going to be talking about navigating the most bullish bear market ever. There are obvious signs that this market is very brittle, very, very weak. Yet every single time the market bounces, overwhelming number of people are screaming at the top of their lungs that was it. That was the bottom. We got to go all in. Maybe they're right. Maybe they're wrong. We're going to take a data-driven approach. We're going to look at a couple of charts to set the big playing field first. We're going to dive into some intermarket stuff. But then I'm going to go through specifically 5 trades that we can put on in this type of market environment, all of them to the long side to take advantage of shorter-term price action. I think there are available setups, and I think that there is an opportunity to make money on the long side in this particular market. Definitely a stock picker's market, though. So before we start, let me know if the mic is working over on YouTube. Let me know in YouTube chat. Make sure the mic is working, and then once I get an okay from one of you guys over there, we will go ahead and start. For those of you that are new to this, my name is Hamilton, and I run the trading initiative we started 5 years ago. We've traded all sorts of cycles, bull, bear, long, short, everything in between. It's fun stuff. Being in front of these trades is how we operate. We focus on where are the institutions moving money? Are they buying? Are they selling? Are they avoiding? Are they accumulating? And that's where we want to do our business. So that's what we're going to focus on. Looks like Mike's good. Let's go ahead and start. So we're going to go ahead and start with a disclaimer. First of all, don't be stupid. Don't risk more than you can lose. And please do not misconstrue anything we say today as buy or sell recommendations. We're simply looking at charts, folks. It's your money. Do whatever you want. First things first, I want to set the bigger picture here. Bigger picture. Where are we in terms of trend, right? Trend is the most important thing to a technical trader. Are we in an uptrend? Are we in a downtrend? Are we in a trendless range? And as of right now, at least according to the S&P 500, we are in a downtrend. We can see it multiple ways, but the easiest way is just throwing a 200-day moving average on the chart. And as of right now, it's sloped down. It takes a long time for this moving average, this 200-day moving average, to start to change its slope. So from moving from up to down takes a considerable amount of time and a considerable amount of data. That data being price. If this starts to trend down, which it is right now, in the past, it has signified potential steeper corrections. We are trading below it. Therefore, you should assume that bears are in control, at least over the long term. Bearish momentum is in play. The S&P 500 for us, inside of TTI, we're looking for a move above 550 to 555, starting to attack that 200-day moving average before we really get long. But I do want to give a shout out here that we did hold our 2021 highs. And I think that's important. Previous cycle highs here back in 2021, super important from a market structure standpoint. If we can hold that, we can at least hold on to the idea that maybe there is a floor somewhere above this proprietary gray box. If we flip below that proprietary gray box, there are very high odds that this bear market here that we're currently in continues into a steeper and deeper correction. As of right now, though, we are holding those 2021 highs. But I really want to be focused on the cues here, right? The S&P 500 holding the 2021 highs, that's good. But most traders are focused more on trading higher beta growth stuff. Let's be honest. Particularly if you're a shorter term trader, you don't want to get bogged down with financial related stocks too much. Inside of TTI, we'll go out and we'll buy some European financial related stocks. Right now, I own a stock, a bank in Amsterdam, Netherlands. I own another stock that's headquartered in Spain, but has all of their branches in Argentina. I'm all over the place. I don't care. But for most retail traders, they want to focus on higher beta growth stocks. And so the NASDAQ is going to be your northern star, if you will. Where are we within the confines of trend within that NASDAQ chart? Well, we're also in a downtrend. The 200-day moving average, which gives us a good understanding of long-term trend, is now sloping down and prices trading below it. You have to assume that over the longer term, bears are still in control. Once again, we're holding that proprietary gray box, those 2021 highs, which is good. That's good from a market structure standpoint. But still, you have to play the game by the rules. We are in a long-term downtrend at this point. If we zoom in here on the NASDAQ. Once again, I think this is the most important chart for most retail traders, at least if you're trying to gauge strategy from a bigger picture. Right, the S&P 500 still has an astronomically large allocation of growth. Right, you think tech, communications, consumer discretionary. Tech is 30% of the S&P 500, but the NASDAQ, it's 50%. So once again, if you're into trading higher beta growth stocks, you got to live or at least be very, very in tune with what the NASDAQ is doing. Okay, so I highlighted a couple more moving averages here to help you guys understand the difference between trend lengths. Now, if you're a longer term trader or investor, that 200-day moving average is your guiding star. You don't play around with it. We're below the 200-day moving average, you're risk off. You're above the 200-day moving average, you're looking to put risk into the market. If you're a little bit shorter term, right, I'm thinking maybe in between a couple of weeks to a couple of months, that 50-day moving average really becomes important to you, that intermediate term trend. And then if you're a shorter term swing trader, where you're looking for days or potentially weeks, the short term trend, that 20-day moving average is now your guiding star. But what we have here is we have confirmation across all three trends. Short-term, intermediate-term trend, and long-term trends are all pointed down with price below them. Today, there was an opportunity for the first time in a month for the NASDAQ and the S&P 500 to flip this short-term trend. That's the first step, right? You have to take the short-term trend before you start to repair the intermediate or long-term trend. I don't think people realize how much damage has been done to this market over the last 2 months. An astronomical amount of damage has been done. It's unfathomable, actually, and we're going to look at a couple charts in a second to really showcase that. But as of right now, we are back below the short-term trend. We're back below, or we've continued to trend below the 50-day moving average, the intermediate term trend, and then also the 200-day moving average. So as of right now, this is, for the most part, risk off, bear market territory. Bears are in control here. Every rally should be, until invalidated, should be thought to sell the rips, right? There's a time to buy the dips. There's a time to sell the rips. As of right now, the market is screaming at us that maybe it's not the right time to go in and buy the Mag 7 stocks. Maybe it's not the right time to plant our flag and say, this is the bottom. Bull market's back in session. It's just not there yet. Also, I want to give an honorable shout out here. Inside of TTI, we look at momentum religiously. Relative strength, the RSI indicator is not, we don't buy the 30 and sell the 70. I think that's horseshit. If you're a breakout or a momentum style trader, you want to buy strength and hold on to it as long as it makes sense. And if you're looking to short, we want to short weakness and hold on to that short as long as it makes sense. What we're looking for here is we divide the RSI in half. We can think about it like this. Above the 50 is bullish and below the 50 is bearish. If you are in a market in a downtrend and the RSI is trending below the 50, which as of right now it is, right? We came up and tapped the 50, we came back down, we came up and tapped the 50, we came back down. And actually today we were up and over the 50 intraday, but market sold off into the close and we ended up closing below it. This acts as kind of a force shield. Right? It gives us a understanding that the bearish momentum is still in control in the market. So not only do we have a series of lower lows, prices trending below short, intermediate, long-term moving averages, we are also still within what we call a bearish momentum regime, meaning bears are still in control. So when people are screaming from the top of their lungs, we want to buy this market, you're an idiot, blah, 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 let them. They don't know what they're talking about. If you're a technical trader, price is what matters. Data is telling you right now that we are in a bear market. Now, if we think about, I was talking about how the NASDAQ is the most important. If you think about the NASDAQ QQQ, it's non-equally weighted, right? The biggest stocks are your Teslas, your Amazons, your Microsofts, your Apples, your Mag 7s, right? Those are the biggest stocks. So those are going to take a commanding lead. There are instances where the Qs, the NASDAQ, will break out and run way before the rest of the NASDAQ components happen, and it will pull the Qs up with it because the weighting of those Mag 7 stocks is so large compared to the other 93 stocks in the ETF. Well, here we have a look at the equally weighted NASDAQ. So every single component of the NASDAQ is relatively worth the same. It gives us a better understanding of that part of the market, the tech, consumer discretionary, and communications, the high beta growth stuff that people love to trade. On average, where are we? Well, we were just looking at the NASDAQ from a long-term perspective. The 200-day moving average, we're trading below it, but we held those 2021 highs. That's a good thing from a market structure standpoint. If you're a bull, you don't want to lose those 2021 highs. What happens when we look at the equally weighted NASDAQ? We lost those 2021 highs. The average stock in the NASDAQ right now is trading below its peak at the 2021 high, at the peak of the bull cycle before we came into the 2022 bear market. So once again, You don't have to argue with me whether we're in a bear or a bull. The data here does not support that we're in a bull market anymore. The data here is very, very obviously screaming, you got to be careful if you're looking to buy stuff here. We could be in for a steeper correction. What I would like to see and what I thought could have happened today, the RSP, which is your equally weighted S&P 500, but we're not going to talk about that today, did briefly flip back up and over its 2021 highs. The NASDAQ, however, did not. We're trading below all three moving averages. We're trading below the 50 RSI, and we're trading below the 2021 highs. Folks, it's not looking great out there for the people that want to plant the flag and say that was the absolute bottom. There's just not enough data there to support that. It's very reckless to take that assumption and start taking your hard-earned capital that you've just made over the last 2 years, and arguably some of the easiest trading environments that you're ever going to see in your life. It was relatively easy the last 2 years. Don't blow all of that trying to be a superhero and timing the bottom. It's not worth it. Let's look at some actual industries really quick. Two industries that take the lead here, traditionally semiconductors and home builders. We're going to start with semiconductors. Once again, just showcasing here that if higher beta stuff, we're really going to start pushing back to the upside, which is what you would expect in a market bottom. You want to trade healthy market bottoms with higher beta stuff leading higher. You don't want to trade market bottoms where consumer staples are leading, or utilities are leading, or materials, or healthcare. These are lower volatility, defensively positioned names. You don't want to see those bounce and lead higher first. You want to see the cyclicals. You want to see the higher beta stuff. Semiconductors, I would say if there's a 1A and 1A and 1B, it would be semis and home builders, and you can flip-flop those given where we are within the market cycle. But as of right now, semiconductors are below a downward sloping 200-day moving average. They're below a downward sloping 50-day moving average. They're below a downward sloping 20-day moving average, and they're below the 50 RSI. Once again, is this a market that you think has bottomed yet? It could have, but the data there is not supporting it yet. I think a move back up and over the 215-ish area, which gave us this really nice breakdown over the last couple of weeks. We reclaimed the proprietary gray box, which is just a joke, folks. It's just a support level at 215. I think you could start making the argument that maybe we have found a bottom, but we're not there yet. And then once again, moving into the next industry group that really gives us that indication of where we're at within the market cycle are home construction names, right? If you think about it, the market bottomed from an S&P standpoint on October 13th, 2022. October 13th, 2022. You don't believe me? Go check it. Home construction through ITB bottomed in June of 2022 and started to rally higher before the broader market did. This was one of the very first industry groups that stopped going down in 2022 and started going up. It was a market leader. And all the way through the end of 2024, it continued on higher, respecting its 200-day moving average until it peaked in November and then lost its ass, right? So the proprietary gray box we're looking for is somewhere around $98. We get up and over $98 in ITB, we can have the argument that maybe we have found a bottom in the market. But we're still trading below all three moving averages. We're still trading below the 50 RSI. We're above the 2021 previous cycle high, which is good, but we're below kind of this neckline here that gives us this risk-off idea. So once again, we need to see semiconductors reclaim that risk-off area. We need to get up and over the 50 RSI, and at minimum, get up and over its short two moving average before you can have any real conviction that semis have bottomed. And then also, along with that, home construction, right? Home construction needs to get up and over its 20-day, and up and over kind of that 98 level before we can start to celebrate. Until that happens, all of this is in the confines of lower prices. That's it, all right? Let's look really quick at an intermarket relationship that's very obvious to understand here. Consumer discretionary against consumer staples. For those of you in TTI, you know this is a very easy way to think about offense versus defense. Consumer discretionary names like Tesla and Amazon. You have a bunch of money, market's booming. What are you going to spend it on? You're going to go out and buy cars. You're going to go on Amazon and buy everything under the sun. And then when markets start to collapse a little bit, money gets a little tighter, maybe people are getting laid off, consumer staples start to shine. Types of companies that you're going to spend at no matter how much money you make. Think Coca-Cola or Pepsi or Walmart, right? You're always going to go there no matter what, whether you have a job or you don't, or you have a bunch of money or you don't. You're always going to spend on those. So if you think about it, consumer discretionary, more offensively positioned stocks in a good market. Consumer staples, more defensively positioned stocks in a bad market. When this ratio, which is all it is, taking XLY against XLP, is moving down and to the right, generally speaking, we're probably in a very weak market or a bear market. You can see that it collapsed in 2022 and bottomed at the beginning of 2023 before rallying from 2023 all the way until the beginning of 2025. Does a pretty good job at identifying whether or not we're in a bull or a bear market. Ratio moves up, we're generally in favorable conditions. Ratio moves down, we're generally in non-favorable, right? Bad environment to be buying dips, bad environment to be positioning yourself in high beta stocks, etc. It's not perfect. You can also use the equally weighted version as well. I do want to point out that Tesla is like 25% of XLY, and we all know Tesla has been crushed over the last couple of months, down 50, 60%. That's obviously going to play into this. But even from an equally weighted standpoint, this ratio is breaking down. So along with everything else we just talked about, the Qs need to catch some sort of momentum up and over the 50 RSI and start to reclaim those moving averages. We need to see industry groups like semiconductors and home builders start to catch a bid. We also need to see this specific ratio start to move up and to the right. It really can be that simple, folks. If you don't believe me, take this specific ratio over to any charting platform you like and go and look at it. Go look at it through history. You're going to find that there's a very high correlation between bull and bear and whether or not this ratio is moving up or down. All right? Right now it's moving down. Last thing I want to talk through, and then we're going to get into 5 trades that we do like in this market, regardless of whether or not it's going up or down, because this is a stock picker's market. While I do think this is technically a bear market, I also think that we are very range bound above those 2021 highs. I'm going to flip back. I know some of you guys are like, Jesus, I can't believe it, but here we are. As long as we're above the 2021 highs, I don't want to be completely out of longs, but I do want to point out, arbitrarily buying dips is not the way to go. You got to be a stock picker here. This is not the type of market that you go and just buy anything under the sun. You have to have a process, okay? So right now, while I do think we're in a bear market, I more so think as long as we're above those 2021 highs, we're range bound until we break down more. And at that point, I think all calls pretty much for the most part are off the, unless you're in inversely correlated assets, don't buy calls in a market in free fall. Not a good idea. Those things evaporate really quickly. But we're not in free fall, at least as of yet. Right? We've recovered slightly here. So we're going to go through and I want to talk about the VIX for 2 seconds. Our intern, Randy, who's starting our new TTI Accelerator program. We're starting a program. If you want to learn how to swing or position trade based off of TTI fundamentals, it's $99 a month. You can come and go as you please. He's there to teach you market analysis every morning. You have access to our course material. It's a nice place for beginners or potentially intermediate style of traders to learn how to swing and position trade. He's going to head that up. We're releasing it, I believe, at the end of this week or beginning of next week. We're just trying to get through a couple of things here. If you're interested, let me know. I'll send you the link. That's going to start. He's going to have control of it. I'll be over there a couple of times a week just to pop in and say hello. But it's a great place for beginners to start. If you're overwhelmed by swing trading or position trading, fantastic resource. You have access to 20 plus hours of me yapping at you and teaching you how to do this stuff. And then obviously you have Randy there during market hours to answer questions, and he'll be trading alongside you. So he put this together here. He's big into the VIX. He really likes volatility. He was talking today inside of our Discord about VIX term structures and how right now we're currently in something called backwardation. I'm not going to go too far into it, but basically the problem is that traders are extremely nervous right now. Generally speaking, in normal market conditions, known as contango, traders expect more uncertainty later, not now. So they're willing to take bigger bets. They're willing to take bigger positions now because they're not worried about right now. They're worried about later. Well, right now, the VIX term structure is telling us the traders are extremely nervous right now. Right? Not, they don't, later maybe not, but right now it's really bad. That tends to have adverse side effects when you're looking to buy something like calls, right? Your premiums are sky high. Any sort of VIX crush in the short term is going to crush the premium on those calls. So you have to be very, very careful right now with what you're actually buying. Okay? So remember what I'm telling you right now. Be very careful with what you're buying. Have a system and be okay with these crazy volatile swings, because right now the market is telling you you have to be ready for those crazy volatile swings. Last thing I'm going to say before we get into the trades, if you don't want to trade a volatile market, there's one easy thing you could do. Sit in cash and wait for all of the bullshit to go by. But if you like to trade, like most of us do, here are a couple trades here that we can get into right now to make some money. This is a trade that I'm going to teach you really quick about how we think about things inside of TTI before we get into the 5 actual trades. This is Agnico Eagle Mines, ticker AEM, a trade that we took a couple of months ago at this point. We've been trimming it. We're now mostly out of it at this point. If you're inside of TTI, follow the chat room. We're snipping most of AEM because we're expecting some pretty big pullback in gold, and this has been a huge winner for us over the last couple of weeks. 3 things I want you to consider here. We're trading above a 200-day moving average. If you're looking to go long, I just made a big fuss about those moving averages. You exponentially increase your odds if you're trading with the direction of the trend, folks. Trade with the direction of the trend. Agnico Eagle Mines was trending higher, so we knew we wanted to be long. That's number 1. Number 2, we're within a bullish momentum structure. We were just talking about how important it is for that RSI to be over 50 if you're looking or thinking that something is bullish. If you're under 50, that's not bullish, folks. That represents bearish momentum. So if we're looking to go long, RSI needs to tell us that bulls are in control of momentum. And then lastly, we need to see relative strength, and that's not the RSI indicator. Relative strength is one asset, its relative performance against another asset. Literally, that's what it means. The way we use it is we want to own things that are outperforming the market. For example, if I ask you really quick, if you want to outperform the market, what's the best way to do that? There's really only one answer. Own the things that are outperforming the market, right? That is generally how pros think about it. You want to own the things that are outperforming the market. And so what we do is we use something like AEM against the broader market, in this case SPY, and it gives us an understanding of how is AEM performing against that broader market. We want to be trading with things that are outperforming the S&P 500. If they're not outperforming, you're wasting your goddamn time. So this right here shows you that as of right now, we're up at all-time highs, or we were a couple of days ago before the gold pullback. We had this nice all-time high breakout, gave us a technical level to base off of. Upward sloping 200-day moving average, or at the very minimum above a 200-day moving average. RSI was telling us bulls are in control, and we had relative strength. And I'm not going to tell you, or I'm not like joking around here when I tell you that if you nail all 3 of these, not all of them are going to be big wins. Not all of them are going to be wins. But if you nail all 3 of these characteristics and you do it over 100 trades, for example, you're really going to surprise yourself with how many of them outperform your wildest expectations. The winners outperform the losers by a magnitude that I don't think I'm professionally allowed to say. But you do it over 100 trades, you're going to see the power of aligning these 3 key features and going out and buying stuff that makes sense. In this particular trade, we hit over a 500% winner in AEM. We were able to trim a bunch of that exposure into strength, turn that trade free rather quickly, and then ride that trend higher. So keep those 3 things in mind as we go through the next couple of trades. Let's get into them. These are trades that you can take with us right now if you want to. When we took them, maybe the options price was a little bit different than where it currently is. Some of it is a little more. They're in profit. Some of them are a little less than when we opened them, so you're actually getting a better deal. It's completely up to you, but this is how we think about the market. All right? Dollar Tree. We like the June 20th, 2025 $95 calls, for no more than $2.50. How does this make sense? We're trading above a 200-day moving average. Trend is on our side. We're trading above the 50 RSI. Bullish momentum is on our side. We're breaking out over a 7 to 9-month high against the S&P 500. Let's break down this entire trade really quick. Going back to the beginning of 2022, Dollar Tree has been in a relative downtrend and an absolute downtrend. Relative downtrend against the broader market, absolute downtrend meaning price is just continuing to come down with a downward sloping 200-day moving average. Then, for whatever reason, off of some sort of earnings report, Dollar Tree gapped down huge, found support at a level that it's found support at for the last decade. Every time it gets down to the 60 area, buyers step in. I don't know why. I don't care. But from a technical standpoint, that means we can reasonably rely on that 60 area to continue to hold. What we found over the last 6-7 months is a range form. We like these ranges formed inside of TTI. For us, that signals that financials institutions are accumulating shares here. Retail traders don't have the buying power to keep I believe it's a large cap stock. I think it's still a large cap. Retail traders do not have the market capital to keep a large cap stock moving sideways like this for 6 months. There's only one type of entity that can do that. That's a large or a conglomerate of large financial institutions. They stepped in. They said, listen, $60 is too cheap for this. We're going to continue to hit the bid here, and we built this range out. Then we get the nice little breakout up and over the 70 to 75 area, and we're off to the races now. We like this specific trade in the short term because it ticks all of our boxes: trend, relative strength, momentum. It gives us this nice island fractal, beautiful TA setup. We're targeting the gaps. As you can tell, we have a couple of gaps we're targeting here, and we only want to hold it for maximum 58 days. But let me go a step further and explain a very simple concept that will absolutely revolutionize your trading. And it's going to seem so mind-blowingly simple when I tell you, if this is the first time, and if you're inside of TTI, please, in chat, let people know what this does for your stress levels and potential profitability in the future. A lot of these trades are going to run an exorbitant amount. Some of them are going to go to zero. Some of them are going to get crushed, and that's part of doing business as an options trader. You don't like to lose, don't trade options. It's just that simple. When this particular trade or any trade that you take, shorter dated, hits 100% in profit, immediately close half. Immediately close half of your trade. So if, for example, you bought this for $250 and it trades for $5 per contract in 3 weeks, 2 weeks, you are going to close half of your open position. What does that do? It pulls back all of the account capital that you originally risked back into your account, and now you are trading with house money. It's a free trade. Let's pretend this trade, for whatever reason, goes to 0% after that. It was at 100, you sold half, it comes back to zero. You lose nothing other than potentially commissions, which aren't really a whole lot of money nowadays, right? But you lose nothing. You covered your ass. It's essentially like doubling up, taking your first amount of money that you had, putting it back in your pocket, and then walking around with the money that you won as your gambling money. That's the best part about this. Now, everybody has their own risk tolerance. Some people like to let these things continue to run. That's what I like to do. I like to let these things continue to run as long as the trend is still higher and I have time on these contracts. Some people like to immediately close the entire thing at 100%. That's it. I'm out. I doubled up. I'm happy. It's completely up to you. I will tell you that I tend to give updates on what I'm doing with these trades. I tend to say, hey, I'm taking half off here. My next price target is here. This is what I'm looking at targeting for the next kind of 25% that I'm taking off, etc. But I really want to stress for anybody listening to this, develop your own exit system that is based on your risk tolerance. That is really what it's about. That's what's going to allow you to perform the best that you can. Obviously, you can take influence on how I do it or anybody else, but it really comes down to what you're able to do. So once again, Dollar Tree, June 20th, 2025, $95 calls, no more than $250. You got 58 days till expiration. We got trend, momentum, and relative strength on our side. First setup there. Second setup that we really like is Roblox. And this one was one that I found end of day today. I was going through the charts. Listen, I have a 4-week-old kid. I really hope Roblox is out of the mainstream by the time this kid turns 5 or 6. I really don't want to have to deal with this. I've never looked at it in my life. I have no idea what Roblox is, but apparently it's very popular. There's a lot of dads in our group talk about it all the time. Their kids were addicted during COVID. Some of them still are. Here we go. Like it above 62. Price target. Next one up, $85. I like this a lot. We're trading north of an upward sloping 200-day moving average. We're back up and over the 50 RSI. And once again, we're pressing up into a potential 3-year high in relative strength against the S&P 500. This is fantastic. For whatever reason, I don't friggin' know. The market loves Roblox, and it's relatively cheap at $2. These things were going for like $9 or $10 just a couple of weeks ago. So we're getting a massive discount on this particular position. The $75 calls position us well because with a price target of $85, we're going to be about $10 or so in the money, right? We have 58 days till expiration. Close half at $4. Let the other half ride to the price target at 85. Or if you don't want to hold it, close the entire thing at 100%. It's completely up to you. But once again, ticks all 3 boxes that we look for inside of TTI. It's a nice trade. Well, and it's a high beta trade. Right? You're not going to be stuck in like some bank stock or some copper miner stock or something. These things move, right? Roblox, I believe, is a 7% ADR, meaning it moves moves 7% intraday. It's a great trading vehicle. Okay. The third one that we're going to be going through is TG Therapeutics. We just posted this today, September 19th, 2025, $55 calls for no more than $3. Now, this is a little different. The last 2 trades have been relatively short, right? June contracts, we're looking to hold these things for maximum 20, 30 days before theta starts to really kick your ass. Going to get out of those then. The September 19th contracts give us a hell of a lot more time. Now, generally, in a market that is trending hard, we like to buy more time because it gives us 2 different benefits. One, we can hold the contract longer if it doesn't immediately work without a huge breakdown in premium. So if you buy something that's good for 6 months, if the stock doesn't immediately move for you, you're not going to wake up a week later and go, God damn it, this thing's down 50%. Generally speaking, that doesn't happen in a market trending higher. So it gives us a little bit of more time. Secondly, If the market is trending higher and the stock does do well, let's say we get our price target within the first 4 weeks of holding something and we own this thing we bought 6 months worth of expiration. We have another 4.5 months to hold this thing without really having to worry about theta kicking us in our ass. Who knows how far these things can trend in a strong market? So if we're able to cover our initial risk by flipping half at 100%, we're able to hold the other half for sometimes up to 5 or 6 months. And that's really where, for those of you in TTI, you know this, that's where you see a lot of the 1,000% winners that we post. It's not on accident. Not all of them go to 1,000%, but a lot of them do strictly because we buy them, manage risk at 100%, and then forget about them. Let them do their thing. If they stop out because the trend dies, that's fine. We don't lose anything. We probably make a couple bucks anyway. If they continue to run, we make a lot of money on these things. So TGTX is a pharmaceutical related company. Love the fact that it held its previous cycle high breakout back up here at the 2021, 2022 highs, held 36, came down, retested it, immediately rebounded up and over it, upwards or trading above an upward sloping 200-day moving average. We're within a bullish momentum regime. Look at this RSI. We haven't been oversold in this since 2023. An incredibly strong pharmaceutical related name. And by the way, this is in the backside of healthcare not looking fantastic. TGTX looks good. If we look at TGTX against the broader market, against the S&P 500, once again, you can see that we're about to break out on a multi-year high. So not only do we have, once again, higher trends on the trading above, a long-term moving average, the 200-day, bullish momentum regime. We have a lot of relative strength against the broader market. They're relatively cheap once again at $3. I think I opened this up a couple weeks ago as it broke out at $3 as well. I think I break even on it. Exact same contracts. And once again, we have a lot of time, 149 days. Flip it at $6, half price target at $56. If it continues to run, it's completely up to you what you want to do. Some of these will turn into 1,000% winners potentially. So there's your TGTX. Next one, Celsius. Now this is a hot topic. I've never in my life drank Celsius. I have no idea what it tastes like. I've been in Brazil for the last 5 years. It feels like they don't have it down here. I'm looking to just trade the price action, folks. I don't care about anything news related whatsoever. Here we go. June 20th, 2025, $45 calls for no more than $1.50. 58 DTE. Once again, short term. A majority of the trades we're taking inside of TTI are short term. You can obviously tell why. The market right now is very, very volatile. We were just looking at the VIX term structure from our intern, Randy. A lot of this stuff is not conducive for longer term swing trades. So we're attacking the market the best way we can with shorter term trades. Okay, so Celsius, we like it because it's up and over kind of this line in the sand at 38. If the chart was a little bit zoomed out here, you'd see that this 38 level is held as resistance and then support multiple times in its past. Here we are pressing up and over once again, 38. I like it. We're up and over a 200-day. Now, the 200-day is still sloped down, so it's a little bit riskier of a play, but we're up and over the long-term moving average, which is step one. As we clear kind of this overhead supply at 38, I really like it north of $53 to $55. We're within a bullish momentum regime, excuse me, and we're showing lots of relative strength going back 6 months against the broader market. Not all of these are going to work, but a lot of them will. And when they do, they tend to work really, really well. So we're looking to take half off at $3 if you get these for about $1.50. Let the other half continue to run to $55. Completely up to you what you want to do after that. But as of right now, June 20th, 2025, $45 calls. That gets you in the money by about $7 to $8 by the time we get to the price target. That's really when these contracts start kicking in. The last one I want to go through, which just came up as I was putting these together, got a DM from somebody inside of the TTI. They said, what about some of the higher beta quantum computing stocks? And he sent me Rigetti. Why not? This isn't normally something that I like to trade, but there's an applicable play here, right? There's a play here. Now, we took this trade at the $3 pivot. We did not hold it all the way up to $17, $18, unfortunately, but there's an opportunity here. It appears to have some sort of bull flag or coil here forming. Think there's an opportunity. We see it in relative strength against the broader market as well. We're up and over the 50 RSI. As much as Rigetti has come back, I mean, this thing has really been crushed from $17, $18 all the way down to about $7.25. This thing is still within a bullish momentum regime. Bulls are still technically in control here. We're trading north of a 200-day moving average. We're within this very, very common kind of symmetrical triangle continuation pattern. What I really like about these types of technical patterns in particular are that when you get these continuation fractals at the top of a flagpole, generally speaking, the underlying trend does resume, and in this case, the underlying trend coming into this this symmetrical triangle was obviously up, right? An explosive move to the upside off of 3 all the way to nearly $18. So I do think that there's a better percent odds of this thing continuing, and if the market does, for whatever reason, find a floor relatively soon, these are the types of stocks that should continue to take off. Once again, you can see the relative strength is off the charts. Now, I want to point something out. There's a couple of these particular plays that we're looking at. I think Celsius and I think Rigetti are both coming up on earnings. So make sure if you position yourself that you position yourself to be able to withstand a negative market reaction. Now, the cool thing is there is 2 to 3 weeks, I believe, until both of these earnings come into play. So you have an opportunity to flip these trades free before earnings. And that's kind of what we call like a lottery ticket inside of TTI. If you are, for whatever reason, in a trade, shorter term trade, it's coming into earnings, you've already flipped it for free, meaning you closed half at 100%, it's completely up to you whether or not you want to hold that through the earnings. I typically do. I look at it as a free lottery ticket. A lot of the times, particularly in a strong market, those earnings reactions will be very, very positive. And that's really where you get a lot of the value on these particular shorter term plays, is when you get big volatility spikes overnight. So it's completely up to you what you want to do here, but keep this in mind that earnings are coming up for a bunch of these types of stocks. So if you're not trading a free contract, if you want to get out it before its earnings, that's fine. If it's free, if you want to let it continue to run and see if it hits it, feel free as well. That's why I really like trading these types of trades. If we can flip it for free, it gives us a free opportunity to hold through earnings, and that's really where a lot of the profitability comes. I'm looking at the June 20th, 2025, $12 calls for no more than about 85 cents. I think right now they're going for 75 cents or something like that. This is a very high IV name, so it's a boom or bust. Expect this to either make you a bunch of money or lose it all. When I'm trading these types of things, I like to take about a fourth of my normal position size, because a lot of the times these will zero out. But the setup's available. You have a catalyst that you could potentially trade into. We have about 30 days-ish to hold this thing if it does work out well. So that's what I'm looking at here. 5 trades for you to take. If you're inside of TTI, the ones that aren't posted yet will be posted tomorrow, but a bunch of them already are. Once again, this is not the type of market to go and plant your flag and say bear market is over. It's simply not there. We looked at the data. We looked at the trends. It's not there. We are taking pot shots, right? We are taking opportunities where we can find them. This is a stock picker's market. We're long some stocks inside of TTI. We're short some stocks inside of TTI. It's really that type of market environment right now. It's a market, headline-driven market, if you will. Case in point today, yesterday, doom and gloom. This morning, fantastic. Last night was fantastic. This morning was doom and gloom. And I think after hours is more doom. I think Trump just came out and said something about more Canadian tariffs, and you know how it goes, right? So make sure you know what you're doing here. Make sure you have your levels clearly defined, and be very wary of overcommitting to one way or the other. This market right now is very, very fluid. It's very, very volatile. Stay on your toes. Okay? I'll be here for another 2 to 3 minutes. If you have any questions, feel free to post them over on YouTube chat, or if you're not a TTI member, you can email me at info@thetradinginitiative.com. What do you guys want to talk through really quick? Did we get the thrust we were looking for end of day? We did not. That's a great question. We did not get the thrust. And we're back below short-term moving averages, which is not great. Today we had an opportunity to nail a breadth thrust that is overwhelmingly positive 3 to 6 months out. We did not nail it. Are we still only taking partial positions? I'm still only taking partial positions, Chad. Yeah. Until those short, intermediate, long-term trends flip to the upside, I'm not playing around down here. I don't I'm not the type of guy that's going to go out and tell people this is the bottom, go long until I'm 100% convinced, and I am not 100% convinced. If there is any part of me that's kind of on the fence, I'm not going to, pardon my French, but I'm not going to fuck around with your guys' money. I'm not going to tell you go long and then watch everything get burned up off of a hunch or a bias. I'm not going to do that. So until the trend's correct to the upside, I'm taking quarter positions, half positions. If they work, great. And by the way, if this is a bottom, if this does turn into a bottom and we have a bunch of quarter or half positions on the books, we can very easily average up into those positions. We'll have a head start, usually before everybody else is in them anyway, so we can just add into those winners as the levels allow us to. Great question. Whenever term structure flips, it usually marks a bottom. Yeah, absolutely right. I agree. So what I'm going to do here, for those of you that aren't in the group, I'm going to drop the link. If you want, feel free to head over there and you can see what we do. And if you're interested in the TTI Accelerator program, that comes out either end of week this week or beginning of next week. I'll send out an email to that. Feel free to respond to that, and I'll give you all the information there. All right, last question. That's a good one. Let's go back to the S&P 500. So the line in the sand for us is, realistically, we got to be minimum above the 1.618 fib extension here at like the 550 to 560 level. At that point, when we're back up and over kind of those July highs of 2024, that's when we can start having the conversation, is this a potential rally here, or is this an actual sustainable trend higher? Level in the sand at 550 to 560 area. At that point, by then, we'll probably be close to the 200-day moving average as well. A little bit of confluence there. Get up and over that previous, or not previous, but the July high of 2024. And if we look at the Qs, it's relatively the same, right? It's the same level. We're looking to get back up and over like 490 to 500. It's the 1.618 fib extension. It's the July highs. Most people that are trading the market that know a couple things are going to pin their expectations to that level. That's kind of the safest place to start getting really long again. I'm not saying it's the best. I'm not saying it's the most optimal. If the low is actually in, the most optimal place to get long was 405, and we fucked up. But there's not enough data there to support that yet, which is why I don't feel comfortable going long there. But I think line in the sand before we really start getting comfortable going max position long again is back up and over those 1.618 fibs, so 497 to 500 in the Qs, and then once again like the 550, 560 area in the S&P. Okay? All right. That was fun. If you have any questions and you're inside of TTI, feel free to leave them below as a comment on the market research portal. If you're outside of TTI, feel free to email me at info@thetradinginitiative.com. I'll get back to you as soon as I can. Enjoy the rest of your night, folks, and I will catch you in the next stream. See ya.